We detected an unusual trade worth $5.5 million on Amazon stock, ticker symbol AMZN. And what's also very unusual about this is that Amazon reports earnings in a few weeks on February 6th. And so in this video, we will analyze this unusual option activity to find out how this wealthy investor is trading Amazon. Are they bullish and buying before earnings or bearish and selling before earnings? Because as we all know, the rich have more access to information, including leaked insider information, to make better financial decisions. No wonder the rich get richer. And so without further ado, let's dive into our analysis. Now, as you can see, Amazon hit new highs on the last trading day on January 23rd. And so this unusual trade could also be a technical trade because it broke out to new highs. So keep that in mind. Now, let's take a look at the data on the options time and sales tape. We can see here 4,750 contracts were being traded at the same time on January 23rd. These February 21st options at the 220 strike calls and the March 21st options at the 235 strike calls. And notice how much they're paying here for these March 21st options, $11.65. And so we can calculate the estimated total trade cost on this trade by multiplying this price out by 100, since each option represents 100 shares of stock. And so each call option costs $1,165 times 4,750 contracts. And so we get a total trade cost of $5.5 million. But keep in mind, this could be an earnings trade. And so this is a higher risk trade in comparison to the trades that we share on our website. And so if you want access to the lower risk, higher probability of profit trades, then go to our website.
Visit www.unusualoption.com to join our membership and start your journey to a financial success with a partner you can trust.
We will also put a link at the top here where you can gain access to better trade strategies that also reduce risk while increasing the chance of profit. Now, if we take a deeper look at this trade on the option chain for these March 21st options, you can see here that for these 235 strike calls, we are also in the same position. POS stands for position, green means buy. And so we also bought these call options for the 11.65 as we had just calculated earlier. And so when we analyze this trade here on the risk profile profit loss graph, where the x-axis is the share price of Amazon stock, it is currently trading over here. And the y-axis is the profit loss. Note the break even line over here. And so when the lines are below it, it is a negative loss. If it's above it, it is a positive gain. And so this is a long bullish trade. And we can confirm it here on the Greeks. We have a positive delta trade. But be aware of the theta risk here. We have a negative 11 per contract. So as time goes on, these options will decay in value, and that is why the purple line drops down lower, because it represents the current date, whereas the blue line represents the expiration date of those options. And that is why the break even shifts up higher as time goes on. And so the stock has to trade above $246 per share for these call options to be profitable at expiration. Now, you may be wondering why we did not analyze the February 21st options at the 220 strike calls. Well, because based on our analysis, these were closing trades. And what they were doing was rolling to these March 21st options. These were the new opening trades. And so a lot of other websites and scanners don't dive deeper into this data to find out which are the opening and closing trades and just report all of them. And so it gets very confusing as to what these wealthy investors are doing. Now, how do we know that this trade was the opening trade? Well, we take a look at the historical data. And you can see that before this trade was made, back on January 22nd, we can see here for these March 21st options, at this 235 strike price calls, we only had an open interest of 11,000 375. But if you look at the data now, after it has been updated, today we now have 15,798 open interest or open contracts. And so we know those 4,000 contracts were new opening trades. But keep in mind, we use position sizing to manage our risk because this is still a higher risk trade because we have earnings coming up. And that is why we also traded this long bullish, but we use position sizing to manage our risk because keep in mind, we have earnings coming up and this elevates the level of risk. And so we don't put a lot of capital into these higher risk earnings trades. Most of our capital is put on the trades that have a lower risk and a higher probability of profit. If you want access to those, we'll put a link at the top here where we also share option strategies that reduce risk while increasing profits. Because keep in mind, not all of these unusual trades will be profitable. Even this one might be a loss, but as long as we diversify with higher quality stock picks based on this type of data analysis, then we can become more profitable in the long term. Let us know in the comments below, do you think Amazon stock will go up after earnings, or do you think it will go back down? As usual, please hit the like button, subscribe if you haven't, take care, and have a wonderful day.